Hello and welcome to this edition of All About Your Company. Thanks for tuning in. Very quickly, today we're going to be talking about Go Fashion and the stock over the last year or so. I mean, shareholders have had a tumultuous ride, right? When I'm looking at the one-year chart, the stock has fallen nearly 60-70% from the highs and thereafter recovered 40% from the lows. Of course, we're still, in terms of the stock price, we're still half of what we were a year ago. So some bit of the recovery is starting to get priced in. We're trying to get a sense as to how this journey is playing out and what will play out over the next year or so that it gives you a better perspective as to how to see this one. It's probably a 5-year low in terms of the stock price even now, or rather the lift from the bottom was where the five-year low was made. So it's good to take a step back and get perspective. That's one. Second is, and therefore, what are the key components of this conversation that we're looking for? One is, when will growth start to pick up? That 5% SSSG growth, which was what was starting to get penciled in. We're still some time away from that. Trying to get a timeline as to when that comes in. And the second one is with regard to the net store additions. That was the other one. And the pivot with regard to it being now starting to become, about how same-store sales growth will really evolve going forward. Really, that's the question which we'll try to quiz management on. In terms of the industry, it caters to the women's bottom wear retail and branded apparel, market. When you're looking at the brand name is Go Colors, which they had launched. And the promoters are, the Saraogi family, currently owned by the Saraogi family. And we will have Gautam Saraogi coming in and speaking to us. This was incorporated in 2010, listed in 2021 with its headquarters in Chennai, Tamil Nadu. The current market cap is 1,800 crore, but I did say that there's been plenty of choppiness with regard to the stock price. In terms of products, you start off with ethnic bottom wear, self-explanatory for most. Then there's Western bottom wear, there's fusion bottom wear, and within that there's palazzos, harem pants, jeggings, etc. You've got athleisure as well, which is more of a growing category. Then you've got denims as well. That's something that they do. Lounge and homeware is the other, set of products that they do. And then there is Dailywear, which is now under a separate vertical, looking at a totally different set of stores. 15 stores already launched with regard to Dailywear, expected to go to 25 stores in the next, 8 to 9 months. So 25 to 30. So that store count will likely double over the next, 6 to 8 months. When you're looking at the Dailywear category, it's largely women's tops. Even men's casual wear is what they've gotten into, which is everyday apparel. When you're looking at the business model, they largely do the manufacturing, which is subcontracted. You've got in-house design and product development, both of which they do in-house. There's contract manufacturing, which they have completely outsourced, and thereafter inventory is held by them. The gross margins are at 63% and you've got an EBITDA margin number of around 28%, which they broadly are working with right now, but they've done 30% plus as well on the EBITDA margin number. You look at the business model in terms of distribution, they do D2C through exclusive brand outlets, which is EBOs, the large format store channel, which is more like the multi-brand retail channel, which is one store having Go Fashion and all of the other, or Go Colors and many other brands, is also something that they do in terms of their sales. And then there's online sales via Amazon, Myntra and the like. The store presence, they've got around 650 stores at this point of time, spread across 164 cities. Earlier, they were focusing on less than 500 square foot stores. Now, they're focusing on 700 square foot plus stores. That's really the tilt. The Dailywear has around 15 stores. I spoke about that. In terms of the financials, they've done 8% growth last 3 years in terms of the top line CAGR. Muted FY26 is what they've had. And thereafter, you've got EBITDA growth also at roughly 4% odd. You've got net profit growth of negative 11%. There's been some drag, and that's because of the store closures they've had. That has impacted profitability, and due to which you're seeing that kind of compression in terms of the FY26 number. You're expected to see more store closures in FY27 as well, but relatively lower is the sense we are getting. Of course, we have to speak to management with regard to how this plays out. In terms of margins, you've got around a 30% margin. We spoke about that, which they've done, which has fallen currently to around 27.5. This probably reverts back. SG&A, which is your promotion, sales and promotion expenses have actually gone up to some extent. So that is one. And the other one is that you've also started to see raw material prices inch upwards. Then you've got the balance sheet. And in the balance sheet, what you're seeing is a 600 and nearly 700 crore in terms of book value. Book value has actually fallen because of a buyback they did in Feb of 2026. So book value has actually fallen. But when you're looking at the kind of price to book that this trades at, it trades at around 3 times book, around 2.5 times book, in fact. When you're looking at cash flow, and there's no debt on the balance sheet except, of course, lease liabilities, and there's a cash of around 155 crore. Cash flow generally is clean. Working capital is where the lockups happen, and that's exactly where they're trying to optimize as well. There is scope for another 20-day improvement in working capital, which sits at around 110 days at this point of time. When you're looking at return ratios, they currently sit sub 15%, which is certainly weak and poor. But there's expected to be a pickup with regard to return ratios once growth comes back. Of course, this is a function of the growth that Go Fashion has been clocking, plus there's been a share buyback as well. When you're looking at shareholding pattern, 56% owned by the promoters. They've held between 53 and 56 last 3 years as well. FI is owned around 4% currently. DI is owned around 26%. So plenty of DI interest, even though it's cooled off. And the public hold the balance. Around 13 to 15% is held by the public currently. When you're looking at the valuations, it currently trades at a 1-year forward price to earnings multiple of around 35 times. The 2-year average is 30 times, and the 2-year range is between 14 and 44. I've taken the 2-year range because the year prior, the valuations were much more stable, and the last year or so, we've seen plenty of movement. So we've just taken the 2-year, and you can therefore see the kind of range as well that they've traded in. Analyst recommendations, there are 4 buy calls, 2 holds, 2 sells, 8% upside, plenty of analyst coverage for an 1800 crore market cap company. That's how we're broadly set up with regard to Go Fashion. On the other side, we'll have Gautam Saraogi coming in, CEO, founder at Go Colors, joining us, giving us a sense as to what to expect going forward. Gautam, coming to you in just a minute. Need to slip into a commercial, come back, have that conversation. Welcome back. Joined by Gautam Saraogi, who's the CEO and founder at Go Colors. Great having you here, Gautam. Let me first start off by understanding how commodity price pressures are playing out and how much of a role that is playing out on your EBITDA and your EBITDA margin. Your gross margin has held up fairly well, nearly 63% or just shy of 63%. But just give us a sense, how much of that are you able to pass through and how quickly does this typically happen? Just let's start with that.
Yeah, thank you for having me on the show. I think for our company, the gross margins have always been intact. I think every year-on-year basis, we've maintained gross margins of more than 60 to 63%. This is largely because of our full price sales ratio. One of the biggest advantages of our business is that ours is a very core and essential wear business, and inventory is fairly at lower risk. And most of our products go to the next season without getting discontinued. And that's why the discounting in our business is very limited. And we given a full price sales ratio of more than usually 95%. And that's why our gross margin on a year-on-year basis has been very steady. As far as raw material pricing is concerned, because of the geopolitical situation, we've seen some increase in prices. As of now, we are not passing on the prices because we have large gross margins. We are looking to bear the short-term fluctuations. However, if there are long-term impact on raw material pricing, we would be passing on the prices and taking a price hike. But as of now, we've not decided.
Okay. Gautam, one critical understanding or question that most of the street has is this SSSG growth, which is largely flat. The medium-term guidance is you get to 5%. What is your sense at the current juncture? When do you get to that 5% number?
See, I think Harsh, it's a number we are also looking to get to. One thing that gives me confidence is that our larger stores, which are greater than 700 square feet, are already positive. They are at about 2 to 3% SSG positive. So when I look at the trajectory of our current stores, larger stores, it's going very well. So as our transition from smaller stores to larger store happens, we will see an improvement in SSSG. Quarter 1 was the first quarter after several quarters where we reported positive SSSG. Still early days, but we are quite bullish looking at the trends of our larger store. When we will get to that 5% number, difficult to predict, but we will start seeing gradual improvement in our SSSG.
And you're certain, in terms of confidence, you're certain that you can get there, because there is the environment has changed a bit as well, right? Over the last year and a half, with D2C brands coming in, competing against you, plus you also getting into newer categories, so that there are a few changes versus what you were doing maybe a couple of years back, right? But despite those changes, you're still certain that you can get to 5% SSSG, and you should be able to get there maybe within the next 12 months, you reckon?
See, we've come out with some really exciting products. Whatever consumer surveys we've been doing, we've seen our product portfolio. Our product portfolio looks very strong. And I think we are very excited looking at our entire bouquet of products. So I think once this transition from smaller to larger stores starts happening, and we are probably at the end of it, we'll start seeing good growth numbers on the overall revenue as far as SSSG is concerned. But again, very difficult to predict when we will be touching that 5%, but we are very, very confident that we'll get there.
Also, does your top line mask a lack of volume growth? I'm trying to get a sense. Again, I'll go back to that answer you gave me with regard to how you're able to pass through some of the raw material costs, right? We've got an efficient way of passing it through. Some bit of it you're absorbing in the near term, because some bit of it you believe will come off as well. But therefore, the top line growth being flat, does it somewhere mask that from a volume perspective, you're actually doing slightly softer growth from a volume standpoint? Is that the right way to look at it? How do you look at it?
Yeah, see, definitely from a volume growth perspective, we have seen a volume slowness. You're absolutely right. The difference between the volume growth and the revenue growth would be our ASP increase. Our ASP actually has been increasing on a YOY basis at a rate of 3 to 4%. That is also because of the newer products what we are bringing in with a slightly higher selling price. See, the trousers and pants category in women's bottom wear is picking up speed, which carries a much higher ASP than our other bottom wear. So whatever new products we are coming out with is by default our ASP is increasing at 3 to 4% on a YOY basis. As far as price hikes is concerned, our one big price hike what we took was back in 2021. As a company, we generally don't take price hikes. We believe that this is a volume-led business. But if there are long-term impact on raw material pricing, then we will have to take.
And volume growth will come with, my understanding again, will come with as you continue to expand the store square footage, right, as one calls it. You've suggested that square footage will increase by 8 to 10% over the next year. Is that the right way to think of it? With the square footage increase, the volumes will also go up. And on a net basis, where will you be in terms of store count?
See, I think the reason we are pushing the data out of square footage increase, that it actually gives us a good bridge between our smaller store closures and our larger store openings. And that transition, this square feet increase gives us the right bridge between the two, where we are closing small stores and opening larger stores. As we keep opening larger stores, as our SSG keeps improving, even our volume SSG will improve. Not only at an overall revenue level, but even at an SSG level. See, at the end of the day, we are a very strong volume-led business. So as this transition happens, as things get fixed in the business, even the volume growth from an SSG level will come back.
And at 5% SSSG on a rupee basis, what should the volume typically be? It will be very low single digit, I would presume, because you said maybe 3% is price hikes and ASP increases and therefore maybe 2%. Is that the right way to kind of think of it, of the 5%?
Yeah,
number?
you're absolutely right. So at a 5 to 6% value SSSG, the volume SSG will be between 1 and 2%, because the ASP increases at 3 to 4% on a YOY basis. So automatically the delta difference between value SSG and volume SSG will be that delta. So the volume SSG will be between 1 and 2, whereas the value SSG will be between 5 and 6 whenever we do get to 5.
And square footage, that contributes positively to volume SSG. Is that, again, the right way to think of your
Definitely.
business?
Yeah, definitely. Because as we are opening larger stores, the customer experience is getting better. We are adding new products. The brand's perception is getting better. That will result in both volume and value SSSG. Now, as far as square feet addition is concerned, we are estimating that on a full year basis, we'll add about 8 to 10% of absolute increase in square feet deployed in the business. But from a store count perspective, where we will end up in March is very, very difficult to predict because, like I mentioned, we are closing many small stores, opening many large stores. So this is a transition year for us. So to give a guidance on the end closing number of stores in March 2027 is going to be a little difficult. Maybe from next year onward, we'll be in a better position to give store guidance. But this year, I think we will end up with an increase of 8 to 10% of square feet deployed in the business.
Okay. And with regard, Gautam, with regard to just store closures, I know that this is an evolving metric for you, and you know, you reiterate that every quarter. But as of today, what should the estimate be? Is a bulk of the store closure behind you? That's the first part of my question. And as of today, is there a number in mind that you have in terms of your evaluation? Of course, that number can change, can increase, but broadly in terms of a floor on how many stores close?
See, I think, look, we closed about 50 to 60 stores in Q1. I think starting Q2, the number of store closures will fall. It will not be to the magnitude of what we saw in Q1 and Q4. Having said that, if we get more opportunities to open larger stores, then we'll close more smaller stores, which is in a way a good thing because in this year we will complete a lot of our transitions by virtue of that. But having said that, from what I'm able to predict, it will be lower than what we've seen in Q1 and Q4.
On the newer stores, on the 700 plus square foot stores that you're opening, what is broadly the ASP? Are you seeing differentiated trends in terms of ASP? That's the first part of my question. The second part is, how do store economics behave? If you can give us a perspective.
So I think ASP is very similar. I think what is the fundamental difference between a small store and a large store is basically the bill cuts, which otherwise we call as footfalls. The footfalls and the number of bill cuts are higher in a larger store. As far as what was the second question? I'm sorry.
How do the economics of the larger stores work versus the small, the break even and the like? Yes, please.
Yeah, Sophie, from a store unit economics perspective, a larger store does about 1 crore of revenue a year. With the EBITDA store level pre-Ind AS EBITDA levels of about 24 to 25%. The investment what we are doing in opening a store is ranging between 40 to 50 lakhs. So we are seeing an ROI of about anywhere between 18 to 24 months and a ROCE of about between 50 and 60%. So very, very strong unit economics. When I compare the unit economics of our smaller store versus our larger store, which is between 700 and 800, very similar unit economics. So we are very bullish that the business unit economics, the overall company's P&L will not change much. See, one of the questions we get is that when we move from a smaller store to a larger store, do the unit economics and EBITDA and ROCEs fall? What we have seen that it's on par. In some cases, the larger stores have actually done better.
Understood. And with regard to Dailywear, that's the other segment where now you've started to differentiate, right? 15 stores independent in terms of Dailywear. My understanding is your large store break-even is 12 to 15 months. Is the break-even for Dailywear also in around the same range, or is it anything meaningfully better or worse, if you can give us that sense?
See, right now the stores are young. I would say they've not completed a year. So the unit economics to a very large extent are unknown. But the one good thing is the 15 stores what we have right now, all the stores are double-digit EBITDA positive. They are more than 15-20% EBITDA positive. Now, the only one thing which is yet to be known for us is what is going to be the yearly full price sales ratio in the Dailywear concept. Like in the bottom wear concept, we have a full price sales ratio of 95%. In Dailywear, where are we going to be ending up from a full price sales ratio perspective? That is something which is unknown, which we will probably know as we go down the road. But as of now, from a profitability perspective, all these 15 stores are very, very highly profitable. We are having more than EBITDA of more than 15-20% across these 15 Dailywear stores. As far as sales are concerned, these Dailywear stores are right now averaging 1,000 rupees sales per square feet per month, which is a very good number for a starting first year. We as management, we expected that the sales per square feet will be around 800, 900, and we've delivered 1,000. So it's in very similar range. So 1,000 SPSF per month gives me confidence that this concept is here to stay and will grow better.
Understood. How quickly do you grow it? You're at 15 now. You go 30 by year end. Next couple of years, where do you see the store count for Dailywear?
See, it's so Harsh, it's merely a pilot, right? I mean, look, apparel is a very tough business, and we don't want to get ahead of ourselves and open too many stores as far as this pilot is concerned. We are going to be opening 25, 30 stores, like you rightly said. We are going to wait for a good 18-month window or maybe a little longer window and get a grip hold of what the unit economics are, what are the inventory turns, what is the ROC. So an 18-month window gives us that comfort. So once we get that comfort, we will take it from there. But our main business, which is our bottom wear business, which is going to be our strong engine over the short term and mid term and long term, is our bottom wear business, and that is going to be our key focus. The pilot, of course, is going to carry priority, but our more priority is going to be more towards the bottom wear business.
Maybe lower on the priority order, but inventory days is something that you've been quizzed about quite regularly. And there is a goal to bring it down and bring it down by another 20% from here, which should improve cash flow quite significantly. You've done a buyback last year. I'm going to couple all of these together. How quickly do you get to 90 days? And what's the plan for FY27? You do another buyback? You continue to repay a dividend to your shareholders? How does it play out?
See, as far as buyback is concerned, yes, we did a buyback last year. And as far as future buybacks and dividend is concerned, that is something the board will decide in due course of time. So little premature and early for me to comment on that. As far as inventory is concerned, we as a company believe that this business can be measured only by the number of turns of inventory you do in a year. And we've constantly had a very strong eye on that number. Even in Q1, we've delivered very, very strong operating cash flow. And I think in the coming quarters, we will continue to optimize inventory. See, currently our inventory is between 100 and 110 days. Obviously, the inventory is slightly higher because we've done this pilot of Dailywear. If I remove the Dailywear inventory and just look at my bottom wear inventory, it's a lot more efficient. So even after considering our Dailywear inventory, we are between 100 and 105 days. So as the quarters keep going, this number will keep reducing and we'll eventually get to the goal of 90 days.
Gautam, last question. You're in the midst of a transition of sorts, right? And a larger part of that, the way I'm reading it, is behind us. Now it's time for the transition gains to start to accrue, right? But when do you believe that a meaningful part of the transition will get over and those gains will start reflecting on your numbers, both top line, EBITDA, as well as bottom line? What would that broad quarter range be?
See, I think, look, the transition is a work in progress, Harsh. I think it will continue for some time. But I think for everyone to watch, I think Q3 onwards, there would be improvement in the business compared to where we were last year. So suppose someone is to compare Q3 versus Q3 this year, they will see a significant improvement in the business. But in terms of how it will span out in terms of numbers, very difficult to comment again. But I think from Q3 onwards, we'll start seeing improvement. And anyways, this transition is more of if it's more of over the next 3-4 quarters, we keep seeing. But the starting point will be Q3.
And FY27, there will be growth. Would you say double digit overall?
See, again, very, very difficult to predict in terms of numbers.
Okay.
But I'm hopeful that we will do well in a Q3 and end FY27 on a very positive.
Okay. All right. Gautam, thank you so much. Really good having you.
Thank you, Harsh. Thank you.
All right. You heard it, viewers. All the time we have on this edition of All About Your Company. Thanks so much for tuning in.